energy outlook, it depends on the scenario we undertake. So in our base case scenario, we still see fossil fuels as remaining foundational to our energy mix to the extent about 67%. But if in a very greening scenario, if we see a lot of concerted push on policy implementation, solving some of the structural bottlenecks on rights of way, transmission expansion, connecting up the grid, making the green energy corridors actually work, and a huge impetus on state level implementation, then we do see the possibility of renewables expanding to as much as 13% of India's primary energy mix by 2050. So it all depends on which scenario we see panning out. In a base case, we still see fossil fuels remaining foundational. In a much more greening scenario, we see the impact of renewables increasing far more significantly to the extent of about 13% in the primary energy mix.
What role do you see for the nuclear energy in India clears energy transitions?
So nuclear energy is a very complicated story because of structural factors related to liabilities, the extent of liability, and also how different the nuclear operator, the supplier, and the government, how they share the liabilities. So I think that is something which still has to be solved. It has to be simplified, it has to be made more transparent, and it has to be made safety. Safety is paramount. The other structural factor is cost. So there is a huge push towards SMRs globally. We see that push coming to India as well, but at this point in time, that technology is still to be commercially proven. It's 3 times the cost of India's current pressurized heavy water reactors. So for deployment, for really nuclear to enter through SMRs into the merit order will be a tall challenge at the moment. It is a much more, so I think a lot of players have to work together to first ensure the liability laws are in place, and then only we will see the private and foreign investors come in. Otherwise, it will still remain a very public sector oriented story where most of the investment would come from the likes of NPCIL and NTPC, with some, we estimate about 20 gigawatts of investment coming as part of the nuclear energy mission that has been announced by the government in the budget, coming by about 2040, in the time frame of about 2047 to 2060. So we see those targets really getting closer to be met in the 2060 time frame because of these structural challenges.
Are private markets deep enough to fund India infrastructures and green mobility push?
So it's a great question because we in our journal do unpack the private credit markets, that it is a developing story in terms of deepening, and my colleague Geeta Chugh talks much more about it. I think there is access to pools of capital. It depends upon what is the objective of that source of capital. If the source of capital is looking at returns on capital deployed on balance sheet returns, then the investors may still look to fund more, assets in coal, oil, and gas. But if investors' objective function is to look at growth over value, including stock market returns over value like dividend payments, etc., and returns on capital employed, then one could look at the renewable stocks far more for investment purposes. So I think it really depends upon what is the objective function of the source of private capital we're looking at.
What we are highlighting here is we're talking about the India's opportunity in the global shipbuilding market, right? If you look at particularly what we are highlighting is the right noises as well as policy initiatives which the Indian government is taking, particularly the Maritime Development Fund, which was talked about as well as came in the budget, 25,000 crores. We also seeing a lot of MOUs which are being signed with Korea and Japan, particularly because those are the leaders along with China. So we do expect India, which has a very low market share today in global shipbuilding, less than 1%. So the opportunity size is big. The government initiative, policies initiatives are on the right track. And India can, over the next few years, along with the maritime clusters as well as investment, start taking a slightly higher market share in global shipbuilding. What it effectively does, it supports your steel industry, it supports your machinery, it supports your manufacturing as a percentage of GDP, which we want to increase, as well as it creates huge employment, right?
So over a period of time, our growth cycles have got synchronized with the advanced countries because we trade more with them. Capital inflows as a percentage of GDP have risen. So in the short run, the pain in the advanced countries or slowdown does transmit to us. Now, as far as the tariffs are concerned, there is a direct impact, which is through U.S., because U.S. is the largest trading partner. With the tariffs, our exports to U.S. become more expensive. So as a result, I think there is some drag on goods exports. There is an indirect channel also through which the current environment impacts us. Indirect means that other countries are also slowing down, so other export destinations are also slowing down. China has excess capacity, so it is pumping goods into other countries at lower prices, which is called dumping, and we are trying to put safeguard duties on them. And then finally, I think there's a huge amount of uncertainty, which today is higher than it was during the global financial crisis or during the pandemic. So as a consequence, I think the global environment will pull us down a bit, but fortunately, I think the domestic factors are very positive right now. We've had monsoons which are broadly normal except for some parts. We also have a situation where oil prices are low. It helps our GDP. It helps to keep current account deficit low. It also helps inflation. On top of that, I think the external factors are, or external resilience is very much there, because we have low current account deficit, so you need less financing from abroad to finance your deficit. We also have 47% of our exports in services, and services exports don't get impacted that much. So that is a natural cushion we have. Forex reserves are sufficient. So I think all these factors are they help build your resilience during turmoil. And we also have a deployed monetary policy. RBI has cut rates. They will slowly move into the system, and that will support the economy. On top of that, I think the fiscal policy space is not much, but government is front-running its capital expenditure, both center and states, and that is supporting the economy. And finally, the GST, it not only will improve compliance over time, but in the short run, I think it will also support consumption demand. So I think the domestic factors are somewhat offsetting the global headwinds, and we will deliver about 6.5% GDP growth.
One of the papers that we've covered in the journal that we've released today is looking at India's evolving approach to foreign trade. We felt that it was an opportune moment to discuss India's wider trade strategy. So what we're discussing is not some of the ongoing changes in global policy or India's approach to it, but just in general, how would India like to do its trade negotiations and trade policy going forward. One of the things we find in the report is that India is less dependent on trade for its growth than other Asian economies. And that has helped India at a time like now. It is a bit more resilient to the changes in the global economy and in different trade policies that we're seeing. But at the same time, we think India's approach is evolving cautiously. They would like to become a bigger player in global trade. They would like to have more integration in the world economy, both for manufacturing and services. And we're talking about how India can do that. So one of the ways, of course, is securing access to new markets. So, for instance, India's exports to the US are only 2% of India's GDP, but India's destination dependence is high. Nearly 40% of all of India's exports are only to the US and EU. So we're looking at this framework where India can start accessing new markets through free trade agreements. And these markets are especially those that are also growing now. So they are emerging economies in the Gulf, in ASEAN, in Latin American countries, and of course in Africa as well. And how they can sort of start protecting and galvanizing the Indian economy going forward as it becomes a bit more outward looking. We also talk of some things that have helped India. So, for instance, India's external trade being so services focused has actually been risk positive for India, and we don't see the role of services reducing. The India-UK trade agreement is a good example of where India wants to do goods negotiation but also wants to do services negotiations, and that is something that we're likely to see going forward even more as India negotiates more FTAs with other countries, other regions, other territories. And the last thing that I want to say is key factor that we've highlighted in the piece is India's labor is regionally competitive. So what we mean by that is that India's labor is young, it's abundant, and there is opportunity for it to be included more into the economy and skilled in specific ways that speak to the certain sort of strengths and leverages of the economy.